Good evening. Welcome back to the channel. I'm your host. This is your James Ajee. If you're new here, we discuss precious metals as macro stress indicators, not as lottery tickets, not as get-rich-quick schemes, and certainly not as entertainment for the hype cycle crowd. Before we touch a single data point tonight, three things must be established. There are accounts across every platform: YouTube comments, Twitter, Telegram, using my name, my profile photos, my exact language. They will DM you. They will offer exclusive research, VIP groups, or managed accounts. This channel operates under one immutable rule. I will never ask you for money. I do not run paid groups. I do not manage capital. I do not send direct messages to viewers. If someone contacts you claiming otherwise, block immediately. They are fraudsters exploiting the community we've built here. Nothing in this video constitutes financial advice. I am not your advisor. I am not licensed to manage your capital. I hold physical metals. I may be wrong about everything I'm about to discuss. You are responsible for your own decisions, your own due diligence, and your own risk management. Do not trade based on YouTube commentary. Do not allocate capital based on personality-driven content. Verify everything independently. This channel filters for independent thinkers. If you need guarantees and excitement, you'll be disappointed here. We deal in probabilities, structural anomalies, and documented uncertainties, not predictions, not price targets with timestamps, and certainly not narrative comfort. The precious metals space is contaminated with guru culture, with conspiracy merchants, with people who've been predicting imminent collapse since 2011. We are not that. We are analysts of system stress. Sometimes that stress manifests. Sometimes it dissipates. We follow evidence, not emotion. Now, community engagement. For the long-term viewers, the OGs who've been here through the dull years and the volatile ones, drop your location in the comments. I want to see where this conversation is happening. London, Singapore, Texas, Johannesburg. The physical metals market is global, and the disconnect between paper pricing in New York and physical availability in Shanghai or Zurich tells us more than any single analyst can. Your location context matters. Tonight's topic sits at the intersection of two events that occurred on the same calendar day, January 30th, 2026. On that date, gold experienced its largest single-day decline in 45 years, 21% down. Silver collapsed 41%. Simultaneously, the U.S. Department of Justice quietly released over 3 million pages of Jeffrey Epstein-related documents. Most of that dump was noise, but buried in Dataset 9 was something specific. A 2011 email forwarded to Epstein containing an article claiming Russia's intelligence services had evidence that IMF chief Dominique Strauss-Kahn was arrested not for the charges that were eventually dropped, but because he had discovered that all U.S. gold at Fort Knox was missing, replaced with tungsten-filled counterfeits. The article itself is fringe, discredited, pseudoscience. We're not here to validate it, but the timing, massive metals crash concurrent with document release, raises a structural question. Why does the mere suggestion of missing gold still carry enough weight to move narrative, if not price? The answer, as we'll explore, is that the U.S. gold reserve has not faced full independent audit since 1953. The books carry the metal at $422 per ounce, absurd given current market pricing. And three high-profile figures who publicly demanded verification in early 2025, Musk, Trump, Senator Paul, have gone silent after Treasury non-response. The email isn't proof. It's a match thrown on fuel that's been accumulating for decades. Let's examine the fuel. The viral memo, the one circulating trading floors and private channels, contains price targets that don't belong in serious analysis. $10,000 gold, triple-digit silver. We're not validating those numbers. Numbers without timeline and probability are astrology dressed in Excel. But dismissing the memo entirely because of sensational targets would be lazy. The memo's value isn't its predictions. It's the single data dislocation it accidentally spotlights. Here's the anomaly. The paper price says one thing. The physical market says not available at that price. That's the dislocation. Specifically, in the 30 days preceding the January 30 crash, COMEX registered silver inventory, the metal actually available for delivery against futures contracts, declined approximately 23%, while the paper price remained range-bound. This is not normal market behavior. In functional futures markets, sustained inventory draws correlate with price appreciation as scarcity signals propagate. The divergence suggests the paper price is increasingly disconnected from physical availability. The mechanics matter. Registered inventory at COMEX represents bars formally designated for potential delivery 1,000-ounce silver bars, 400-ounce gold bars, stored in approved vaults with serial numbers and weights recorded. When registered metal departs without price response, one of three conditions exists. First, the departure is anticipated and hedged by commercial participants, masking supply stress through derivatives positioning. Second, the paper market is sufficiently dominated by algorithmic trading and speculative flows that physical signals are drowned out. Third, and most relevant to our framework, the paper market is trading promises at prices the physical market no longer validates. The Shanghai Silver Exchange tells the same story from the opposite geography. Physical silver premiums in Shanghai, what buyers pay above the international benchmark, have remained elevated at $1.20 to $1.80 per ounce, despite the paper crash. Arbitrage should close this gap. Metal should flow to where price is highest. The persistence of this premium indicates either logistical friction, shipping, insurance, timing, or preference for local physical possession over paper claims in international markets. Direction of flow matters. Metal is moving west to east. London and New York vaults to Shanghai, Singapore, Dubai. This is not speculative positioning. This is structural reallocation by central banks and sovereign wealth entities who view Western paper markets as increasingly synthetic. The paper price says $30. The physical market says not available at that price. That's the dislocation. Everything else, memos, emails, political demands for audit, derives from this core tension between a pricing system designed for liquidity and a physical market approaching delivery constraints. 3 data points, same story. The paper market is trading promises. The physical market is running out of metal to deliver. Current registered silver inventory stands at approximately 88 million ounces, down from 150 million ounces in early 2021. The distinction between registered and eligible is legally precise and practically ignored by most market commentary. Registered metal sits in vaults with intent for delivery, serial numbers, assay certificates, warehouse receipts matching outstanding short positions. Eligible metal is technically present, but not currently designated for delivery. The critical threshold. When registered inventory approaches the volume of outstanding deliverable contracts, the exchange faces a forced liquidation event or rule change to avoid settlement failure. As of last report, registered silver covers roughly 12% of open interest in deliverable months. Historically, this ratio above 20% indicated comfortable liquidity. Below 15% triggers exchange scrutiny. Below 10% historically preceded either price spikes to discourage delivery demands or administrative adjustments to delivery specifications. The implication is straightforward. COMEX silver futures are priced as if physical delivery is a theoretical option. The registered inventory trajectory suggests delivery is becoming an operational constraint. The Shanghai silver premium has persisted at 4 to 6% above international benchmarks for 18 months. In functioning arbitrage, this gap closes within days. Traders buy low in London, sell high in Shanghai, capture the spread minus transport and financing costs. The gap isn't closing. 3 structural reasons. Chinese export restrictions on refined silver implemented in 2024. Increasing domestic industrial demand from solar panel manufacturing. And central bank accumulation patterns that prioritize physical possession over price optimization. Metal flow direction reveals preference. Silver departing London and Zurich vaults for Shanghai is not returning. This is not inventory cycling. This is permanent relocation of physical stock from Western paper market infrastructure to Eastern sovereign possession. The Commitment of Traders report shows commercial participants, bullion banks, and swap dealers holding net short positions in silver, equivalent to approximately 35% of annual global mine supply. Concentration this extreme has occurred twice in the last decade, 2019 and 2021. Both instances preceded significant price revaluations, though direction varied by macro context. The risk is covering velocity. Commercial shorts are hedges against physical inventory or forward sales. If physical delivery is demanded against short paper positions and registered inventory is insufficient, covering becomes a scramble for actual metal rather than cash settlement. Historical context. The 1980 silver spike, the 2011 peak, and the 2021 gamma squeeze all featured commercial short covering under physical stress. None featured the current combination of depleted registered inventory and sustained Eastern physical demand. These three metrics, inventory coverage ratio, persistent geographic arbitrage, and commercial concentration, measure the same divergence. Paper pricing assumes metal availability. Physical markets demonstrate metal scarcity. The gap is the risk. Technical analysis in manipulated markets is not about prediction. It's about identifying where algorithms will manufacture liquidity, or engineered volatility. Gold's 14-week RSI currently reads 41, bouncing from oversold territory below 30 during the January crash. Silver's weekly RSI sits at 38, similarly recovering from deeply oversold conditions. These readings don't signal buy or sell. They signal exhaustion, selling pressure temporarily depleted, allowing for either mean reversion or consolidation before the next directional move. The relevant observation: oversold conditions in precious metals during structural supply deficits historically resolve upward, not through continued decline. The 2008 crash, 2013 smashes, and March 2020 liquidity event all showed similar RSI profiles. Each preceded significant revaluations within 6 to 12 months, though volatility during the bottoming process inflicted maximum pain on leverage. Gold currently trades below its 50-week moving average, $2,680, but maintains position above the 200-week, $2,140. This golden cross structure, long-term average rising below price, typically indicates secular bull market continuation, despite intermediate corrections. Silver's structure is weaker. Price has violated both 50-week, $29.80, and 200-week, $23.40 averages, trading currently near $24. This breakdown would typically suggest bear market conditions in conventional technical frameworks. However, the physical market data discussed previously, inventory draws, Shanghai premiums, Western outflows, suggests the technical breakdown is paper-driven, rather than reflective of physical supply-demand fundamentals. Declining volume on down moves during January's crash, followed by increasing volume on stabilization, suggests distribution completed and accumulation beginning. This pattern is visible in both GLD and SLV ETF flows, though we treat ETF data as secondary given potential creation-redemption manipulation. I don't trade these levels. I watch them to understand where algorithms will create liquidity, or engineered volatility. Large commercial participants know where stop losses cluster, where trend-following systems trigger, where retail leverage concentrates. Technical levels in precious metals are not organic price discovery. They're hunting maps for entities with inventory information retail cannot access. The technical snapshot indicates structural weakness in paper pricing that physical data does not confirm. This divergence, paper technicals bearish, physical fundamentals tightening, is the condition that generates explosive resolution when paper fiction confronts delivery reality. We began with two events on January 30th, 2026, a historic metals crash and the Epstein document dump containing a fringe article about missing Fort Knox gold. We dismissed the article's claims while recognizing its catalytic effect on legitimate audit questions. We examined the data dislocation. COMEX registered inventory down 23% pre-crash, while paper prices flatlined. Three metrics, inventory coverage, Shanghai arbitrage, commercial concentration, show paper promises diverging from physical reality. Technicals suggest paper weakness that physical conditions don't confirm. The paper market isn't broken by accident. It's designed to absorb volatility that would otherwise destabilize currencies. But designs fail when physical supply runs out. This is the structural condition we face. Western precious metals pricing infrastructure, COMEX futures, LBMA forwards, ETF creations, functions as a volatility suppression mechanism. It allows monetary metals to act as safe havens in narrative, while their prices remain administratively manageable through derivative layering. The system works until delivery is demanded against paper claims that exceed available metal. We are approaching that threshold. Registered inventory at coverage ratios below 15% historically preceded either rule changes to avoid settlement failure or price revaluations that forced short covering. The January crash, 21% gold, 41% silver, occurred alongside this inventory depletion, suggesting engineered volatility to liquidate leveraged longs and deter physical delivery demands. The paper market's design assumes physical metal exists as backstop. The Fort Knox audit questions, 1953 last full independent inspection, $422 book valuation versus $5,000 plus market price. Musk, Trump, Paul, silence after Treasury non-response, suggest even sovereign backstops face credibility gaps. The resolution window is 8 to 12 months, not because of prediction, but because of structural constraints. German gold repatriation took 4 years, 2013 to 2017, despite being a single sovereign claimant. Current physical demand involves multiple central banks, sovereign wealth funds, and industrial users simultaneously. The logistics of metal movement, vault capacity, transport security, assay verification create hard bottlenecks. Within this window, we expect either: first, administrative intervention. COMEX rule changes expanding cash settlement options, redefining deliverable grades, or extending delivery timelines. This extends paper market viability, but accelerates physical market migration to alternative venues. Second, delivery stress event. A large participant demanding physical settlement against concentrated short positions, triggering covering cascade and price discovery outside paper market control. Third, audit resolution. Congressional pressure forcing Treasury to permit the independent inspection Representative Massey's bill demands. Drilling bars, independent verification, public reporting. The unresolved question: which occurs first? I could be wrong. The bearish case against precious metals appreciation rests on 4 credible risks that must be acknowledged without dismissal. Industrial silver demand, photovoltaics, electronics, automotive, constitutes 55% of annual consumption. A synchronized global recession, particularly in Chinese manufacturing and European renewable energy deployment, would collapse fabrication demand faster than investment demand could compensate. Solar panel installations, the primary silver demand growth driver, are capital-intensive and recession-sensitive. A 30% decline in global solar deployment would remove 100 million ounces of annual silver demand. The US dollar index at 110 plus changes precious metals pricing dynamics significantly. Gold and silver are globally priced in dollars. Dollar appreciation mechanically suppresses metal prices for non-dollar buyers. A flight to safety bid into treasuries during systemic stress typically strengthens DXY simultaneously, creating headwinds despite safe haven narrative. The dollar's reserve status persists not because alternatives are absent, but because transition costs and network effects delay displacement. Exchange force liquidation through margin requirement increases has precedent. CME Group raised silver margins 5 times in 8 days during the 2011 peak, collapsing price from $48 to $34 within 2 weeks. Similar administrative intervention during stress events can override fundamental supply-demand conditions temporarily. COMEX rule modifications expanding cash settlement or redefining deliverable bars could extend paper market viability indefinitely, despite physical constraints. The January crash demonstrated how quickly 40% plus drawdowns can occur in silver. Leveraged participants face liquidation risk regardless of long-term thesis. Physical holders checking daily prices generate behavioral pressure to exit during volatility spikes. The structural thesis fails if COMEX registered inventory stabilizes or increases above 120 million ounces. Shanghai premiums collapse below 50 cents sustained. Or a credible, independent Fort Knox audit occurs without incident. Bearish cases are delays, not invalidations. The structural supply deficit doesn't care about quarterly GDP prints. The 2008-2009 period demonstrated this dynamic. Industrial demand collapsed, but investment demand for physical metal increased 140% as monetary uncertainty dominated. Recessions in fiat-denominated systems trigger solvency concerns, not just liquidity constraints. Precious metals outperform during periods of central bank balance sheet expansion, which recession guarantees. DXY strength in 2022 preceded gold's 2024-2025 revaluation, despite continued dollar elevation. The dollar's structural position, $38 trillion federal debt, $2 trillion annual deficits, sanctions overreach accelerating de-dollarization, limits sustained appreciation. Foreign central bank gold accumulation continues regardless of DXY fluctuations. Their buying is strategic reserve diversification, not tactical trading. Solar panel silver loading per watt has declined 80% since 2010. Yet total silver demand from photovoltaics has tripled due to installation volume growth. AI data centers, new demand category not priced into 2024 supply models, requires silver-intensive power infrastructure and thermal management. Substitution away from silver in electronics has exhausted low-hanging opportunities. Further reduction requires technological breakthroughs, not just price sensitivity. 3 developments since January 2025 validate the structural thesis independently of price action. China's continued gold accumulation, reported 18 months running. Central bank buying at record pace despite elevated prices. And major bank target revisions. JP Morgan post-crash, $6,300 plus gold, framing the crash as correction within larger bull rather than cyclical peak. The paper price says recession risk. The physical market says reserve restructuring. Physical markets determine long-term outcomes. Know which one you are. Physical holders checking daily prices are masochists. Traders holding through 10% drawdowns are gamblers. Pick a lane. You already own the asset. Price volatility is irrelevant to your position unless you're forced to sell. The appropriate action is no action. Verify storage security. Ignore quote screens. Revisit allocation only if your macro thesis changes, not if your emotions fluctuate. If you don't have 12 months of living expenses in liquid non-metal assets, you're overallocated and vulnerable to forced liquidation. You operate in paper markets with leverage. Your relevant metrics are position sizing, stop discipline, and correlation management, not inventory data from Shanghai vaults. The January crash demonstrated 40% intraday moves in silver. If your position sizing assumes 20% maximum drawdown, your model is already broken. Trade the levels, hedge the tails, size for survival. You discovered metals during recent price attention. You've missed the foundational education phase and are entering during narrative peak. Your risk is overenthusiasm, leading to concentrated entry at local highs. Dollar cost average over 6 to 12 months. Study the 2011 to 2015 bear market before committing capital. Physical premiums above spot, currently 8 to 12% for Silver Eagles, represent immediate loss on purchase. Your break-even requires spot appreciation you cannot predict. Identity clarity prevents behavioral errors. Confusion between these categories generates the regret cycles that destroy wealth regardless of asset performance. Paper versus physical disconnect is measurable and widening. COMEX registered inventory, Shanghai premiums, and commercial positioning all signal divergence between derivative pricing and metal availability. This gap resolves, timing uncertain, direction probable. Memo authenticity uncertain. Structural stress is verified. The Epstein email and its fringe claims about Fort Knox are unverified and likely fabricated. But the audit questions it amplifies. 1953 last inspection, $422 book valuation, 2025 political silence. are documented and unresolved. 8 to 12-month window for resolution. No price targets. The convergence of inventory depletion, sovereign demand, and political pressure suggests near-term administrative or market response. We do not predict prices. We observe conditions. Will COMEX change delivery rules before physical supply breaks, or will we see the first true price discovery in decades? Everything presented here is publicly available data or documented historical record. Verify independently. Sources include COMEX warehouse reports, CFTC commitment of traders, Shanghai Silver Exchange, U.S. Treasury financial statements, and congressional legislation tracking. Do not trust personalities. Trust documentation. Invest with logic, not hype.